Thank you for standing by and welcome to the Arena REIT FY21 results. All participants are in a listen-only mode. There will be a presentation followed by a question and answer session. If you wish to ask a question, you will need to press the star key followed by the number 1 on your telephone keypad. I would now like to hand the conference over to Mr. Rob de Vos, Managing Director. Please go ahead.
Good morning, everyone, and a very warm welcome to Arena REIT's results presentation for the 2021 financial year. Our announcement, investor presentation and financial statements were released to the ASX earlier this morning. My name's Rob de Vos, Arena's Managing Director, and joining me on the call today is Gareth Winter, Arena's Chief Financial Officer. Before commencing our presentation today, and recognising that many participants on the call are in lockdown and some for the second year running, on behalf of the Arena team, I'd like to acknowledge the challenges the pandemic has presented, but also acknowledge the resilience and support that we've seen from our stakeholders through this period. I'd particularly like to thank our tenant partners for their tenacity and their ability to continue delivering essential services to Australian communities. In our usual format, today's presentation will include an overview of the highlights of the financial year and an update on our performance against strategy. Gareth will provide insight into Arena's financial results and capital management position, and I will close the presentation with an update on portfolio operations and commentary on Arena's outlook. As always, there will be an opportunity for questions at the end of the presentation. Moving into the presentation on page 3, and despite the external challenges, I'm pleased to report that financial year 21 has been a successful year for the business. We've made solid progress against our investment objective and ultimately achieved strong outcomes across the portfolio, which has contributed to strong investment outcomes and ongoing positive outcomes for the many communities across Australia that use our properties. Our highlights for the period include a record statutory profit of $165 million, underlying cash-based net operating profit of $51.9 million, which is up 18.5% on financial year 20. We've seen further valuation growth across the portfolio, contributing to an increase in net asset value, which is up 15% over the 12-month period. We've deployed $106 million of capital into exciting new projects in Victoria, New South Wales, South Australia, Western Australia and Queensland. We've taken the opportunity of strong direct market conditions and divested 6 older early learning properties at a premium of 16% on prevailing book value, and we've recycled those proceeds back into our development pipeline, which now includes 15 projects with an anticipated total cost of $91 million. We've collaborated with our tenant partners that has provided the opportunity to do more for the environment, and at the same time significantly increased the portfolio WALE, which now sits at over 20 years and by far the longest in the Australian listed REIT market. Obviously, this is consistent with our objective of providing our investors predictable distributions over the long term. Gearing remains below 20%, providing balance sheet capacity to take advantage of new opportunities that are consistent with our strategy. And we've distributed 14.8 cents per security in financial year 21, which reflected a 6% increase on financial year 20. And today, we're providing distribution guidance for financial year 22 of 15.8 cents per security, reflecting an increase of 6.8% on financial year 21. So pleasing operational and financial outcomes in an active period for the business. Moving on to the next slide. Underpinning those positive outcomes achieved through the year is Arena's consistent approach, strong industry relationships and high conviction on maintaining our discipline and executing on strategy. Highlights for the period of the team's key focus areas are the extension of portfolio WALE to over 20 years, which is principally a result of collaborating with our largest tenant partner, Goodstart, to extend 87 leases for a further 25 years in a program where Arena is responsible for installing solar power systems across all of our Goodstart-owned sites. This is a great outcome for all stakeholders, with environmental benefits from a reduction in carbon emissions of over 1,000 metric tonnes per annum, benefits to our tenant partner from meaningfully reducing their utility costs, and benefits to the community as those savings will be reinvested back into children's programs. The cost of the installation program, which is anticipated to be around $5 million, will be borne by Arena and offset against securing over $610 million of future rent. During the year, we sold 6 early learning centres that, relative to the balance of the portfolio, are older and less efficient, for total proceeds of $17 million and a premium of 16% to book value. And we've seen further valuation growth across the portfolio of $108 million for the full year. Passing yield for the portfolio is now 5.77%, having compressed by 45 basis points. We've maintained 100% occupancy across the portfolio, which has been the case for now over 5 years. And this achievement really highlights the quality of the portfolio, the strong underlying fundamentals that support the social infrastructure sector, and the proactive asset management programs undertaken by the Arena team. Average rental growth was 3.3% across the portfolio. It is worth noting that this includes the 25 FY20 market reviews that achieved an increase of 6.5%, which is consistent with results from prior periods. During the period, we made further progress on our renewable energy program that is focused on collaborating with our tenant partners in an attempt to install and promote the use of solar and reduce the energy intensity of our portfolio. We also completed 6 refurbishment programs with 2 tenant partners, which provide for better amenity for families, better rents to Arena, and a reduction in terminal value risks of those properties. In relation to rent relief programs, all of our tenant partners remain compliant with agreements struck in FY20, and we've received 100% of contracted rent through the year. We've acquired 7 operating properties, 6 in metropolitan Melbourne and 1 in Brisbane. Each have been acquired on our preferred long-term triple net lease, and in aggregate cost $40 million, and have provided a net initial yield on all costs, including transaction costs, of 6.1%, and an initial weighted average lease term of 27 years. In addition, we've completed 14 early learning centre developments with 5 new and existing tenant partners. These projects had a total investment cost of $74 million and a net initial yield on all costs, again including transaction costs, of 6.6%. We've replenished our development pipeline with the acquisition of 9 new early learning centre development sites. Each of those have been pre-committed on a new 20-year triple net lease, and combined they have a forecast cost of $54 million. Moving on to an update on the COVID impacts on the business on slide 5. And as I mentioned at the start of the call, we're very aware of the challenges that the pandemic has had and is continuing to have on many of our stakeholders. As Arena's portfolio exclusively accommodates essential community services, we've been somewhat sheltered from the financial impacts that other businesses are dealing with. Nevertheless, we remain vigilant in assessing the direct and indirect risks of the pandemic, including the risk of heightened inflation during and following the recovery period, which is a risk that Arena is well positioned for. At an operational level, all of Arena's properties are open and trading, delivering essential services. We've received 100% of contracted rent paid to June 21 and therefore have no arrears. All repayments of deferred rent agreed in financial year 20 that has fallen due has also been paid. Progress on our development and origination programs has largely been unaffected to date. Looking forward, our medical centres will play an important role in assisting the national vaccination program, and whilst attendances are reduced at both medical centres and early learning centres during lockdown periods, there is precedent for strong rebounds for those seeking elective procedures, as well as families resuming routine programs for early learning. What has been consistent through the pandemic period is the efforts by the federal government to ensure that early learning services remain open and viable, not just for now, but for the important contribution they make to an enduring economic recovery, allowing parents and carers to get back into the workforce and providing opportunity for better financial security, particularly for women. Moving to the next slide. During the year, Arena released its 2020 sustainability report, which provides the detail on our commitment to strategies that address sustainability challenges and opportunities faced by our business and our stakeholders. We've made good progress throughout the year on these strategies, including a material increase in the use of renewable energy, reducing our tenant partners' utility costs and reducing the negative impacts on the environment. We've increased our stakeholder engagement, which has allowed us to collaborate and create partnerships for positive change. And we've also identified new sustainability priorities for the business, which will be presented in our 2021 sustainability report, which will be released next month. Sustainability is fundamental to our investment approach, and we think that that approach best positions our business to achieve positive long-term commercial outcomes. Our development activities are not designed for short-term profits. They're designed to be flexible and efficient for our tenant partners with sustainable rents for the long term. which allows our tenant partners to focus on their core purpose of delivering essential services to Australian communities. We have a disciplined investment process, and being an internalised manager with strong governance protocols means that we are aligned with investors for the long term. We are looking for sustainable growth in our financial metrics, not short-term scale. Our partnership approach promotes ongoing business and mutually beneficial outcomes for all of our stakeholders. And if we do all of these things well, not only will we achieve those positive sustainability and commercial outcomes, we will continue to broaden our universe of capital providers, with a growing number of investors seeking better sustainability and social impact attributes from businesses they invest in. And in that context, Arena is very well positioned. I'll now pass you over to Gareth to provide detail on our financial results.
Thanks, Rob, and good morning, everyone. Just turning to page 8 of the presentation, you will find a summary of Arena's operating income statement for the year, which shows the 18% increase in net operating profit to $52 million and a statutory profit of $65 million for the year. A reconciliation of net operating profit to statutory profit is included in the appendix to the presentation, with the most substantial reconciling item being the periodic revaluation of investment property. Operating EPS of 15.2 cents is 4.5% higher than FY20 and was in line with our expectations. The key driver of the increase in operating profit is the 11% increase in property income, which has been derived from a combination of rent reviews and capital deployment. Like-for-like rent reviews averaged 3.3%, noting that this includes market rent reviews for around 10% of the portfolio, agreed at an average rate of 6.5%. Arena's ongoing program of investment in ELC developments and new acquisitions contributed to earnings via capital deployment of $106 million in FY21, including the completion of 14 ELC developments and the acquisition of 7 operating ELCs in conjunction with tenant partners. There was also capital recycling of $17 million from the sale of 6 ELCs at a 16% premium to book value. Some specific comments in relation to rent collections in FY21. Arena's portfolio has demonstrated high resilience throughout the pandemic period. There are presently no rent arrears, and all of contracted rent for FY21 has been received, including the collection of $1.4 million of deferred rent. COVID-related rent deferrals were relatively short-term, with 72% of rent deferred in FY20 received in FY21, with all $2.1 million of remaining deferred rent scheduled to be received within the next 2.5 years. Deferred rent has been previously recognised in income and is booked as a receivable, with only the cash inflow to come. I was looking at some other line items. Other income includes fees from our healthcare property syndicate, which was extended by investors for a further 2-year term in late 2020, and interest income. Property expenses primarily increased due to additional allowances for independent valuations and property inspections due to growth in the portfolio. There was a modest increase in operating expenses in FY21, primarily due to costs related to the growth of the business, including custodian and corporate insurances, and also some expenditure related to the ongoing development and advancement of Arena's ESG programs. Pleasingly, and this points to the benefit of our internalised management platform, is that revenues increased by a comparative $6 million and cash OPEX increased by less than $100K in FY21. The reduction in finance costs reflects a combination of the reduced cost of borrowing and the significant expansion of development WIP, increasing the capitalisation of interest, which was $3.6 million in FY21 versus $2.1 million in FY20. The average monthly development WIP balance was circa $60 million during FY21 compared to around $35 million in FY20. The overall cost of borrowing has reduced to 2.65% compared to 3.15% at June 20, primarily as a result of lower swap rates. The higher statutory profit of $165 million is due to the growth in net operating earnings and also the higher positive asset revaluations of $108 million in FY21 versus $37 million in FY20. Given the substantial deployment of capital in FY21 and greater clarity on the impact of COVID-19 on tenant operations, Arena's FY21 distribution guidance was upgraded in December to 14.8 cents per security, representing growth of 5.7% on FY20. As Rob mentioned, we've given guidance today for FY22 distributions of 15.8 cents per security, representing growth of 6.8%. With that growth due to the annualisation of capital deployed in FY21 and we would also expect our payout ratio to be consistent with recent years. Page 9 presents a waterfall chart of EPS for FY21. This demonstrates the relativity in individual items supporting EPS growth, noting that the rent abatement has no impact in FY21 and that the key drivers of growth remain ongoing rent reviews and the deployment of capital into development and acquisitions. Also notable is the effect of the capital raising performed in late FY20, with our relatively low gearing throughout FY21 providing substantial opportunity for further accretive investments into FY22 as the remainder of that capital is deployed. Turning to page 10, this slide presents a summary of Arena's balance sheet. The full balance sheet is in the appendix to the presentation. Key points to note are that the growth in total assets is due to the $106 million invested in acquisitions and developments in FY21. The asset revaluations of $108 million, which is also the primary driver of the 15% increase in the asset value per security, less a reduction in cash holdings, which reduced by about $70 million over the course of the year as we felt more comfortable holding less cash throughout FY21. Net gearing at just under 20% is well below Arena's maximum gearing range of circa 35 to 40%. However, this level of gearing provides substantial liquidity to fund the existing pipeline of developments and will enable us to continue to take advantage of growth opportunities at a low incremental cost of capital. It also provides a buffer around any future market volatility. Gearing is expected to increase by around 3% as the existing development projects are completed. Turning to page 11 and the capital management summary. Our approach to capital management continues to prioritise resilience and risk reduction. At 30 June, we had $90 million of immediately available liquidity through our debt facility to cover the $57 million of development commitments. This, in combination with our modest gearing, allows us to actively consider further growth opportunities. The weighted average debt term is 3.7 years with no expiry before March 2024. This incorporates the recent extension of our March 23 expiry, which was extended out to March 26 in July. Our all-in cost of debt has reduced to 2.65%, with interest rate hedge cover presently at 81%. If interest rates remain around existing levels, we expect that our average cost of debt will further reduce over time as there remains positive reversion value in the hedge book. Finally, I will note that Arena operates well within the requirements of our debt facility, and we have very substantial headroom in both our LVR and ICR covenants. I'll now hand you back to Rob, who will update you on Arena's property portfolio. Thank you.
Thanks very much, Gareth. I'm now on page 13. So as at 30 June, Arena owned 249 properties across Australia with a value of about $1.1 billion. Portfolio is approximately 66 hectares, predominantly residentially zoned, with improvements that are almost exclusively purpose-built for our tenant partners. The portfolio accommodates over 20,000 families in their early learning needs, as well as contributing to the needs of 8 communities' primary healthcare needs in our medical centre portfolio and 35 people with high physical support needs in our SDA portfolio. The portfolio is in great shape. There's the longest contracted rent profile in the REIT sector, and to give that some context, the value of contracted future rent is well in excess of the current total portfolio value. We have an exceptionally strong occupancy record, having had no vacancy for over 5 years. The portfolio has low single asset concentration, with the largest single asset accounting for only 2% of the value of the portfolio. The land and building rate remains under $1,700 a metre, which looks like compelling value when measured against other real estate asset classes. The passing yield is 5.77%, which has seen compression of 45 basis points in the last 12 months, which added with rent increases has provided for valuation growth of just under 12%. With increased investor interest in social infrastructure property, the current low interest rate environment and recent strong direct market evidence, we see the likelihood of further yield compression and as such the likelihood of further valuation growth in the short term. Sector diversity for the portfolio has not materially changed in the period, and geographically we have over 83% of the portfolio located in the high population areas of the eastern seaboard states. In terms of tenant diversification, we continue to improve our spread of tenant partners, now totalling 32, with 27% of Arena's income supported by Australia's largest early learning provider, Good Start. Moving on to the lease expiry profile, and as you can see in this graph on this slide, with only 10% of the portfolio's income expiring in the next decade, and no material concentration of expiries in any year to beyond 2044. These are obviously very long-term cash flows that have annual escalations providing real growth to our security holders. All of the leases are triple net with no exposure to variable property expenses, so highly efficient and highly predictable. Every one of our early learning centre properties and our SDA properties provides us important business operating information data, and that assists us in our asset management and capital allocation decisions. And that's been an important tool for us in assisting the portfolio remain 100% occupied for over 5 years. Moving on to our rent review profile on page 15. And here on this slide, we've broken down our rent review structures for FY22, 23 and FY24. At the bottom of the first column, you can see that 76.5% of this financial year's income is subject to a review at the higher of CPI and a fixed amount, which is generally 2.5% or 3%. Moving up the same column, 11.2% of this year's income is subject to a CPI increase. If you add those two components together, that is the dark blue and the dark grey components, you can see that at least 87% of this financial year's income will escalate at least as high as CPI, providing strong inflation protection. Further up the same column, we have 9% of fixed reviews, which will average to around 2.9% through the year, and 3.4% of income is subject to a market review. And each of those market reviews have now been resolved at an average increase of 6.5%. It's a similar profile of annual rent reviews in financial year 23. And in financial year 24, we have more market rent reviews, totalling 16% of that year's income. All of those reviews have a collar at the passing rent. In other words, the rent can't go backwards. And half of the reviews are subject to a 7.5% increase, a cap, I should say, 7.5% increase cap, whilst the other half have no cap on increase. Moving on to page 16, our origination programs are performing well. We've secured a targeted pipeline of quality early learning centre development projects that will complement the portfolio and deliver future earnings growth. The 14 projects that we completed in financial year 21 were designed and completed to suit each individual tenant's operations. And we and our 5 tenant partners are very pleased with the new additions to the portfolio, and particularly pleased with our Coomera development with Edge Early Learning that won the Best Community Service Facility at the Master Builders Award night in the Gold Coast a fortnight ago. So great stuff there. Looking forward, in total, our development pipeline has 15 early learning centre projects that are located in Queensland, Victoria, South Australia and New South Wales, with a total forecast cost of $91 million, of which we have capital expenditure outstanding of $57 million. We anticipate that the average initial yield on all costs for these projects will be 6.2%. Each of these development projects are being undertaken on a fund-through basis, and we've secured agreement for leases with existing tenant partners on every project in our standard 20-year triple net lease format. Arena is a leader in early learning development and has an enviable record in executing on its development pipeline. Over a third of our early learning portfolio has been developed by us since listing in 2013. And in that time, we've completed 54 developments with 13 tenant partners across all states and territories except the ACT. Moving on to the next slide. And as has been publicised, the federal government support for the early learning sector through the pandemic has been significant, and for the very most part, well designed and well received by operators that required support, particularly through the early lockdown periods. Both major political parties and Australian communities more generally recognise that a well-performing early learning sector is integral to assisting parents and carers, and particularly females, get back into the workforce in the short term and ongoing on a sustainable basis. There is also a growing awareness of the positive lifelong learning prospects of children that attend early learning services, and the broader role that plays in creating a more socially and emotionally well-adjusted community and a more qualified and productive workforce in future generations. The macro drivers supporting early learning sector continue to be positive, with increases in female workforce participation and children using long day care services, which now sits at a 52% national participation rate. In relation to supply, net new supply of early learning centres was consistent with FY20. Across the country, there were a net addition of 297 centres, against a net addition of 294 centres in financial year 20. So that's net growth of about 3.6% over the last couple of years. Moving on to the next slide. Arena's early learning portfolio is in a strong position. We're 100% occupied with 100% of contracted rent collected through financial year 21. Every one of our early learning centres is open and trading, and every one of those centres is providing us business operating data, and that data provides us important information, as I mentioned, that assists asset management and capital allocation decisions. It also provides us insight into the general health of the sector. And as we've done in previous reporting periods, we've included operating data up to the prior quarter, and that data for our portfolio provides average underlying operator occupancy has increased marginally over the 12 months from March 20 to March 21. Daily fee growth has also increased to reflect an average of $114 per day, which remains significantly below the government's benchmark fee of $135 per day. As you can see on the graph at the bottom of the page, the government's funding package continues to suit our early learning centre portfolio, which is typically geared towards middle-income families. And to give this some context, 97% of our early learning centres have daily fees under the government's childcare subsidy benchmark fee as at March. Our average rent per place across the portfolio has increased marginally to $2,549 per place. Given that we've developed more than a third of the portfolio over the last 5 years, it remains highly affordable in our view. Despite strong rent increases across the portfolio, rent affordability has improved for our tenant partners with net rent to revenue ratio of 11% as at March. Moving on to the next slide. And our healthcare portfolio continues to perform to our expectation. And like early learning, the macro trends for healthcare also remain positive. A higher number of people are moving into the older age brackets, and a higher proportion of the population is living with chronic illness, which underpins an increased need for healthcare services and the infrastructure to accommodate those services. We've seen increased investor interest in Australian healthcare property, which is reflected in an increase in asset values for our healthcare portfolio. And whilst we continue to be attracted to new opportunities in the healthcare property market and aspire to grow this part of the portfolio, we've no desire to rush while the market is heated and grow simply for scale's sake. In our usual disciplined way, we're looking for quality over the long term that will support our investment objective on a sustainable basis. Moving on to the outlook. And today we're announcing full year distribution guidance for financial year 22 of 15.8 cents per security, an increase of 6.8% on financial year 21. The portfolio is in a strong position, 100% occupied, 100% of rent collected through the year, a very long WALE with transparent and highly predictable rent profile that has inflation protection. Income growth is underpinned by those contracted annual rent increases, as well as the impact of our financial year 21 and financial year 22 acquisition and development completions. Looking forward, early learning and healthcare services are integral to economic recovery and improving community outcomes. And those important themes underpin Arena's portfolio value and investment objective of providing long-term predictable distributions to our security holders with prospects for growth. We have substantial balance sheet capacity to take advantage of new opportunities that are consistent with our strategy, with gearing at less than 20% and no debt expiring falling due until March 24. Our experienced management team has strong industry relationships and in-house development and origination expertise that will assist us in sourcing future opportunities in a disciplined manner. In closing, I'd like to thank our team and our tenant partners for contributing to the positive investment, portfolio and community outcomes that have been achieved in financial year 21. That concludes the formal part of today's presentation. So I'd now like to pass the call back to our operator, Darcy, to open up the questions.
Thank you. If you wish to ask a question, please press star 1 on your telephone and wait for your name to be announced. If you wish to cancel your request, please press star 2. If you're on a speakerphone, please pick up the handset to ask your question. Your first question comes from Simon Chan from Morgan Stanley. Please go ahead.
Oh, good morning, guys. Rob, you mentioned acquisitions and whatnot in the childcare space. I was just wondering if you could give us some insights into what you did on the healthcare side of things, in the last 6 to 12 months. some of the opportunities, if you don't want to name specific opportunities, just talk about where the market ended up transacting at versus, your expectation of pricing and just give us a feel for what you're doing in that space.
Yeah, thanks, Simon. Look, as I mentioned, certainly a part of the portfolio we aspire to grow, and it would be fair to say we've been bridesmaid on a couple of transactions over the last couple of years, in fact. Look, we can compete. Our cost of capital, we can compete on yields. Where we get nervous on transactions is really around the rental profile. We've got such a strong portfolio, and obviously our investment objective of making sure things are there for the long term and sustainable. It's really around the rental profile, and there's been a number of transactions that have been reasonably high profile over the last 6 months. Expect there'll be a few more that sort of dribbling through. We'll continue to participate, but we're only going to put a foot forward where we know we can sort of nail on a sustainable rental basis, Simon. And that's the piece. I mean, to give you an example, and this is an old example, but we've got sale and leasebacks in Victoria at $1,000 a metre in far out suburbs. You'd only just call them metropolitan Melbourne. So, just building up reversion value issues in undertaking those programs. And I think, as a general comment, I think that the healthcare market is a little exuberant on valuing things in yields in perpetuity when, I think that there will be some rental reversion issues in that sector going forward.
Yeah, okay, that's very clear. And just my second question today, your portfolio size is getting bigger and bigger. Are you at a stage now where you're perhaps going to consider getting some form of rating to get capital market debts, which will be a lot longer duration, or are we not there yet?
Yeah, it's good question. Gareth, do you want to field that on?
Sure. No, it's something that remains actively under consideration. So it's something that we talk about on a regular basis, and not yet. As you would know, we've talked previously around there's a threshold around that $1 billion mark in terms of assets. We've just crossed over that. There's no particular need to do it. We've got very supportive banking syndicate who are giving us the liquidity we need at the moment, but it's certainly something that remains under active consideration.
That's great, Gareth. Thanks, Rob. Thanks, Gareth.
Thanks, Sean.
Thank you. Your next question comes from Caleb Wheatley from Macquarie Group. Please go ahead.
Morning, Rob and Gareth. Just a couple of questions from me. The first one just on the divvy guidance. I'm just wondering if you give any additional colour on components going into that, in particular things like rental growth, cost of debt, any development completions you expect through FY22?
Gareth, do you want to field what's
Sure.
behind?
It's pretty much done on what we term a status quo basis. So we've got an existing development pipeline that we assume will complete as we expect it to over the course of FY22, which is, but that's the only kind of development activity that we assume in that guidance. So I assume no new acquisitions in that process. In terms of cost of debt, it's pretty much as we're currently saying it is at 2.65%. Obviously, there is some positive reversion value in that swap book, but we don't necessarily assume that that's going to come to pass. We're obviously waiting for those existing swaps to mature before they're replaced with new ones.
Yeah. The only other thing, so Caleb, there's probably nothing in the disclosure, so nothing more in addition to the disclosure we provide in regards to completion of other things. The one thing is in regards to CPI, we've not got carried away with what is high CPI rights. So we're just taking what I think is a conservative view in the different states on those as well.
Sure. And just on the profile for those development completions, so about 90 million set to complete over 22 and 23. Is that largely in a straight line, you would say, from here, or?
It is best to model that in a straight line basis. Yeah, that's right. So you'll see those sort of rolling out evenly over the next 24 months.
Sure, that's great. And just the second one from me, just an update on the outlook for deployment. Stabilised acquisitions looking to be more difficult. Obviously, none completed in the second half. So it looks like development is the focus, but yield on cost seems to have come down a bit. Just wanted to get your view on how you're looking to deploy that balance sheet as these opportunities come up.
Yeah, certainly seeing strong opportunities on the fund throughs, which is where we've got our deepest experience. We'd like to do a little bit more with, like we did in the first half of 21, where we've bought a portfolio with an existing tenant partner. They've bought the business and we've bought the real estate, and then collectively upgraded those services. That's great business for us and like to do more. But I think at this stage, the expectation would be more fund throughs, more of what we've been doing, I guess, Caleb.
That yield on cost number seems to have come from 6.6 at the half year to 6.2 on the development pipeline. Is there any colour you can provide around what's happened there?
Yeah, definitely. I think there's definitely the input costs on development have gone up over this period. We've seen not just raw material cost increase, but labour cost increases, which is primarily a result. I think the business. What we try to do is back solve to a sustainable rent on a long-term basis. So, if you like, that means if you're keeping those rents pegged as best you can, it means that the yields are obviously going to come down a little. We feel pretty comfortable about where they sit, though. Still with sixes in front of them. There's been a lot of direct market evidence. I think there's 109 transactions over FY21 of completed properties. And yields have very significantly increased. In fact, the few that have dribbled into FY22, Caleb, interestingly, I think there's one childcare centre that has actually transacted over 5%. Most are now trading at 4%, and I think the average is about 4.6%. So, as a premium to completed stock, we think that our security holders are still being well rewarded for the risks that we're taking on.
That's all I had from me. Thanks very much, Tim.
Thanks, Caleb.
Thank you. Your next question comes from Lou Parenk from Jarden. Please go ahead.
Yeah, good morning. A few questions for me. Rob, can you talk a little bit more about the asset recycling and if you have any further non-core assets that you have in mind for disposal in 22?
Yeah, thanks, Lou. Obviously, the market being hot is we continue to sort of look at what might be at sort of the bottom quartile. And as a whole comment, we're very comfortable with the portfolio. It's obviously performing exceptionally well. There's always one or two that you sort of say at the bottom end of that. I mean, we look through a lens of very long-term WALEs and making calls on probability of renewals, 25 or 30 years out sometimes, Lou, and take a view that the market might pay more for that, and we can recycle into these development programs. Don't expect any large divestment programs from us. There's always one or two through the year that we've done. We did 6 FY21. I think it's a little less than that in FY20. That it would not be a dissimilar number at the high end.
Yeah, and just, linking that to Simon's questions on healthcare. That's clearly, that portfolio hasn't gotten any bigger. It's a great portfolio, but would you, with the demand for healthcare, would you consider at some point saying, sell that portfolio and just be a pure childcare REIT?
Always, look, we as a global comment, we like the diversity that provides. We always set the business up so that we would have a diversified portfolio of social infrastructure property. They have been working sort of in a homogenised fashion over the pandemic period. There's no question about that, and the healthcare values have increased to a point where you sort of look at those and say, would we? But look, they're fulfilling what they're meant to do under our investment objective, is delivering that long-term predictable distribution. We were successful last year in extending those leases out. The properties are performing really well. I don't think there's a need for us to be out there, but if saying that, there is a price for everything. But at this stage, I wouldn't be expecting us to be a seller. We would frankly aspire to be doing more in the healthcare space given those strong macro trends.
Great. And then finally, clearly you've improved your will significantly with that Good Start transaction. In your experience, kind of how important is that for the next round of asset revaluations? Yeah,
it's a good question. Look, there's no doubt that these will be. If you look at the marginal buyer of childcare is typically a high net worth individual buying at an auction. And if you had particularly a tenant like Good Start that might have been sitting on a 10-year lease, they are selling like hotcakes at the moment for obvious reasons. But if you put it to 35, there's not a lot of it, or certainly the valuers in the discussions we've had I think that there's a premium to be had there. We've done some work internally, and that will form the basis of discussions with valuers for our next half results. But we do certainly see it as a premium to be had there, Lou.
Great, thank you.
Thank you. Your next question comes from James Drews from CLSA. Please go ahead.
Yeah, good morning, Rob and Gareth. Two questions, if I may. First one, just what inflation you're assuming in guidance, and just remind us of how that inflation mechanism works in terms of the review.
Yeah, yep, thanks. So, so about 87%, as we sort of mentioned, is for FY23 is subject to CPI or higher, if you like, James. And as to the mechanism, we use consumer price index on all groups for the relevant state, and that's important because I think in the last quarter the all cities was something like 3.8, but you had quite a bit of disparity. You know, Melbourne was down at 2.9, and you had Brisbane sitting at 4.9 as an example. So yeah, quite a disparate spread. We have not picked up those high or low ends. In fact, we're sort of sitting at around that RBA inflation type rate is our expectation. So the cash rate from the RBA, so 2.5% is kind of where we've plugged those.
So just to confirm, so you're assuming 2.5% in your guidance.
It's as a CPI right at the moment. We haven't because things are bouncing around so much between the states, and we're not sure what the sort of consumption looks like or the CPI right looks like over future periods. We've sort of kept a pretty conservative view on that.
Makes sense. And it's an annual review or quarterly or?
They're pretty spread. They're spread reasonably. So they're an annual review is the mechanism under the lease, and the frequency of them is pretty evenly spread. So you'll pick them up, pretty much 50% in each half.
Okay, that's clear. And the second question is just around, I mean, there's fewer more institutions coming into the childcare sector. In terms of sourcing acquisitions and fund through developments, how are you finding the competition?
Not challenging at all at the moment. Our competition's always been, private developers that can sort of move super quick, got the cash, can lay it down without all the compliance, rightfully the compliance and governance that the business like ours goes through. So that's sort of point one. And point two is it's a very fragmented market. As much as we've grown over the last 5 or 6 years, we still account for only 3.5% of the accommodation in the country. So lots more to be done. Look, I think it's flattering. I think that there's a number of groups, including us, that have done it really well, and will continue to do it really well. And look, there's a lot of hard work that makes it look easy, I've got to say. But there is definitely more competition in there, and there is room in the market for that competition too, I should say, James.
Yeah, that's clear. And then finally, just on the gearing, obviously still pretty low. Can you just remind us on where you think equilibrium is and how long it will take to get there?
Yeah. Gareth, did you want to handle that one? Yeah.
So we, in the last few years, we've been running around that mid-20s to 30%. We obviously quote a maximum gearing range of 35 to 40, but that's kind of looking through the cycle. So you'd look to us getting back to where we've kind of got to over the last few years in terms of our levels of gearing. But certainly, there's a lot of capacity there for us to do more.
Yeah, thank you.
Thank you. Once again, if you wish to ask a question, please press star 1 on your telephone and wait for your name to be announced. Your next question comes from Murray Connellan from Moelis Australia. Please go ahead.
Hi, good morning. Rob, you've obviously made reference to how far out your WALE has been extended, and obviously Good Start accounting for quite a large proportion of that extension. Would you be able to break out how the WALE on Good Start leases compares to the rest of your portfolio at the moment?
Yes. So perhaps the best way to look at it, Murray, would be we had something like 12 years. It's got 12 years well with Good Start prior to, and it's sort of gone out by 25. So that's 37. So that's significant increase, and it almost exclusively is the increase in WALE that we've seen on the 12 months. Getting those couple of acquisitions that had higher up to 30 years, because there's so few of them, didn't really shake the dial. So it is all about Good Start. Their decision-making process was really, we like these properties. It wasn't all of them, I should say. We've got 15 assets that weren't included in that extension, and there was reasons for that. One of them is that they had an existing that portfolio of 15 properties that we didn't extend has over 10 years of WALE in itself, and there's a view that there's probably more that we could do collectively on those assets as to giving them a birthday and refreshing them. So that will be something that we sort of work through with Good Start. I hope that answers your question there, Murray. Does that help your question?
Yeah, that's great. Thanks very much.
Thank you. Your next question comes from Jeff Pell from Goldman Sachs. Please go ahead.
Good morning, guys. Just a quick one from me, just going back to healthcare. You mentioned, obviously the strength in valuations and the competition in the market, but I'm curious to see what you're seeing in terms of opportunities for the disability assets, where there's a trading and who potentially is going after those assets.
Yeah. Good question. Thanks, Jeff. So there's perhaps it's not as we saw a lot of opportunities in first half 21 that we could have participated. Looks the mandate, a mixture of different tenants, typically undercapitalised, but we can sort of get our heads wrapped around because of the macro themes there. The risk, and I think I've explained this, in fact, maybe even on this call 12 months ago, the risk we've always seen is the potential for changes in what was new legislation around the NDIS scheme, and with this, as I think most people have said, there's a lot more noise around that. So that's got us a little bit just watching that carefully. The deal flow, I think, as a market, there's not as much that's sort of kicking around on SDA as there was. There's been a couple of small funds that have been raised, sort of syndicate type funds that have been raised and doing some small stuff. That's not really where we want to be. We want us to be at like what we've done with SA Care in South Australia, sort of larger end and more scalable. I think that there will be opportunities in time, but we would like to see government's response to, I guess, fixing, if that's what's needed, the NDIS framework. And I understand that there is discussions going on between the feds and the states in regards to that at the moment.
And just in terms of, your exposure now to healthcare, how are you thinking just, across, you do have a mandate to invest across social infrastructure, and right now it's just primarily childcare and healthcare. Any other kind of, sectors look attractive to you across that social infrastructure spectrum, and how large could your exposure get outside of childcare, going forward?
Yeah. Look, it's obviously very large, and one of the challenges of social infrastructure, it's not particularly well designed. One of the things I don't think you'll see from us is going out and buying sort of office type buildings with a tenant. We're more into primary use of social infrastructure in communities. So, my best example is we'll invest in medical centres, but we won't invest in a New South Wales Health sitting in an office building in the CBD. So that just to draw that distinction, we're into the macro need of the community is what we're really sort of those cash flows that derive from that. There is very significant opportunity. Obviously, the community need continues to grow, and I think out of this pandemic period, we'll see another leg up in that, Jeff. So I think the private market generally and Arena REIT will be a beneficiary of that community need in regards to the accommodation. There's a number of things that sort of can sort of fit into that lens. We look at all of the ancillaries, but still sort of land back on childcare is providing best risk-adjusted returns at the moment in our view. They're very clear in regards to the sort of transparency of the underlying cash flows and how that works back through an efficient building and then into our security holders' hands. So that is our current preference. As I said, we'd like to do more in the medical space and particularly around that primary care and medical centres, again, like our existing portfolio. But the one caveat I've got on that is just some of the rents, particularly in more recent deals, have been not suiting our investment objectives. So we'll continue to look in those two spaces predominantly, and then use the other sectors. There's a whole heap of others, aged care, education, others. We'll continue to look at those as possibilities for the future, but certainly not in any rush.
Thanks, Rob.
Thank you. There are no further questions at this time. I'll now hand back to Mr. DeVos for closing remarks.
Thanks very much, and thank you everyone for your attendance on the call today. It obviously concludes the briefing. Please don't hesitate to reach out to Sam, Gareth or I with any questions, and we look forward to seeing a number of you, albeit virtually, over the next coming days and weeks. Thanks very much.
Thank you. That does conclude our conference for today. Thank you for participating. You may now disconnect.